Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, May 24th, 4:37 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market: we're in a correction. Day three off the lows of this correction. Yesterday, a little bit of optimism with the second day up, but overnight, actually after hours yesterday, a huge warning from Snapchat hit social media. Big gap down this morning, but we bent, but we didn't break. I'm going to get into that a little while. Check the trend gauge over here. You can see we continue for just about a month now, a little over a month, to be on the bearish slash downtrend side of the market. And this isn't our opinion, this is a fact. Market leaders, there's really no leadership to be found from a growth perspective outside of oil stocks. And the 5 major moving averages that we review in these videos are all trending below their short-term 21-day exponential moving average, below their medium-term 50-day moving average, and below their long-term 200-day moving average. And that pretty much tells us all we need to know about the market. That's our signal to play it light, not buy breakouts, buy the bottom of the range and sell the top of the range. Take profits when quickly when they are to be had, and just wait for better days in the market. Right, basically walking around with an umbrella up is the equivalent of what we're doing. So as I mentioned, what happened today, S&P bends, but it doesn't break. Here are the numbers on the day. G6 continues to lag, down 2.7%. S&P gap down 1%, broke recent lows, but rallied. Closed down 0.8%. We'll take a look at the charts momentarily. QQQ down 2.13%. Dow up again, positive by 0.15%. Mid caps down 1.2%. Russell down 1.6%. Global diversified 60/40 stock and bond down 0.33%. In-house, we're down approximately 0.27% on the day, giving back some of yesterday's gains. So let's move to the tail of the tape. But first, let's move to the team here at Revere. Trend following is what we do. Some people like to derisively call it market timing, call it what you will. We participate in market uptrends. We back off during consolidations, and we get the heck out of the way during downtrends. Down about 6% on the year versus down 17+% for the S&P 500. We'll take that. We pride ourselves in being stewards of our clients' capital and protecting the downside. That's how we roll here at Revere, and all our money's in the same strategy as our clients, and we believe in putting our money where our mouth is. So if you're interested in this approach, you can email any of us, Dan, Tim, Hunter, Mural, or me, Don, at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's get to the charts and the tail of the tape. So as I mentioned, day 3 off the lows, same headwinds that we've been dealing with for months. Put call right around 1, VIX around 30, fear and greed around 12. So really, ideally, if we're writing a book, we would see a big flash, a big quick, harsh sellout of about 3 to 4%. Put call would spike to about 1.4, 1.5. VIX would jump up towards 40. We'd have a harsh positive reversal after that sell-off, kind of try to clear the decks, and at the same time maybe see some relative strength leaders holding up, forming bases. Very few bases to be had now outside of the oil patch. So as I said, our umbrella's up. We're in wait and see mode. Any attempts at a bull case have failed, most recently on 518. So we're operating under the bear case, below the moving averages, and not a healthy market. So news, I mentioned after the close yesterday, snap warning. hit pretty much all social media companies. Facebook down 7.6%, Google down 5%, was down quite a bit more than that. Snapchat down 30%, harsh. And then again, after the open, new home sales came out, big miss, down 16.6%. That hit all the home builders and home builder ETFs. So what were we watching coming into today? Some optimism after yesterday, second day up off the low, but Snap really quickly put the screws to that after the close yesterday. We had that gap down of 1%. So what we were watching from a support standpoint was the most recent support that had flipped to resistance, is 3950-ish area. And then down below that, around 3,900, but and resistance on the upside 4050 to 4070. But we gapped below S1. That's this 3945 to 55. We was tested and failed later in the day, so that has now flipped to resistance from support. This S2. 3890 to 3900 area, we got down as low as 3875 intraday before bouncing, so undercut and reclaim of that. Let's take a look at the charts here, blow them up, and here you can see the low of the day, 3875. The lows from Friday still holding. That's a hammer that we put in, very similar to this. So what we're seeing is a day down, and then 2-3 days up into resistance. We didn't even get the second day up in this case. As I said, some optimism with the charts and a lot of support here at this 3800 area, and I'll detail that again. And a theory that I have, but it's just a theory. So not so nice, but we did close at the top of the range. So as I said, bent but not broken. Let's take a look at a 15-minute chart here. And you can see here's this 3900 area. Here's the low from Friday, this 3910, where we rallied hard off of it, continued through on Monday. A little bit of optimism, got through this 3950 area, which had been some resistance. But then we gapped below it today, tried to test it into the close below it, but we did hold this 3875. You can also see this 3876 area over here from Thursday that we undercut but reclaimed on the late rally on Friday into the close to close the week. So what's my conspiracy theory? My conspiracy theory is that somebody or someone, something, some entity does not seem to want the market to close into this official bear market level, which is really this 3837 to 3855 area. Every time we come down and test that, we're getting money coming into the market and keeping us above that. Maybe if we do close on the S&P with officially a 20% below the highs, that's going to be all over the news, and there may be, and then this is the theory that I was talking about, maybe big money. I've seen this happen before. Big money has some programs that if we start a bull, we hit 20% down, that they get more defensive to try to preserve capital, and that may lead to more selling. Just a theory that I have. Although we did see in December 2018, we bounced intraday right below this 20%, and then one day, and then bought up the next day. Now we've pierced it 3-4 times this level and closed above it every time. So as I said, conspiracy theory in me says somebody does not want us to close below this high minus 20% level, the official bear market level. So you can see the action intraday today. Gap down, tested 3875. Then we did kind of an ascending base, higher highs and higher lows throughout the day. And frankly, I thought that this was pretty good action after the way we were selling off early down to this 3875 level. Kind of expected let's look at a 5-minute or a 1-minute chart here. Now let's go to a 5-minute chart, and you can see we started out in one of these frozen slope down moves, and then it accelerated, but then we based right here shortly after 10 o'clock, and that put in the lows for the day. So if you're a bull and you're grasping for straws, you can look at that and say, things aren't as bad as they seem. Things are pretty bad in the charts of individual stocks, and what we did see today was really just a rotation out of anything tech into let's go to the sector alert up here. You can see out of anything that was tech related, that's XLC, K, and Y, and into energy, and then the defensive sectors, XLP, staples, U, utilities, V, healthcare, and RE, real estate. Gold and silver had a good day today. Bonds had a good day today. Home builders bad, retail bad, jets bad, and wheat coming off. So a couple of notes. We're working on the eighth week down for the S&P and the NASDAQ, ninth down for the Dow. FOMC minutes tomorrow afternoon, 2 p.m. Eastern, could cause a little bit of volatility, so we'll be looking at that. So what do we do in-house today? IVV, we took that position yesterday, but when we broke that 3950 area and really on the gap down and then continued lower. Once we broke that, that was the support that we reclaimed yesterday, held for 1 day. We broke it. We blew that out. So we took like a 1.1% loss on that position in the S&P 500 ETF IVV. We did buy gold. So let's take a look at GLD and we'll talk through this very quickly. Let me get these stochastics off of here. So GLD pierced its 200-day moving average 2 weeks ago on the 19th. So that was last Thursday. We had a gap up on gold, back tested the next day, held the 200-day moving average, gap up on Monday, gap up on Tuesday, back above the 21-day. So this broke a big downtrend line here, as you can see with this gap up, and it's holding the gap up. And we're also got a bunch of alerts recently on some gold stocks that are acting quite a bit better, and that includes today. I'm going to look at 4 of them quickly here. Newmont Mining bouncing off the 200-day moving average. This is the big institutional favorite. Royal Gold holding at the 200-day moving average. RGLD, AEM, that's Agnico, reclaiming the 200-day moving average today, bouncing off that 50 support level going back a couple of months. And finally, GOLD, Barrick Gold, undercut but reclaiming the 200-day moving average. So these, for the time being, have stopped going down and are showing some relative strength, and that was the reason why we bought, as I said, GLD, 5% position in that. So reduced our adjusted beta from 0.3 down to 0.11 with the exit of the 20% position in IVV and entered GLD. GLD actually has a negative correlation to the S&P 500, so this really didn't add much to the beta at all. So bottom line, S&P 500 bends but doesn't break, holding above that bear market minus 27% level. So you can see, back to the index very quickly, below all the moving averages badly. Got one close above the ADMA, one close yesterday, one close above the ADMA last week, and it continues to just give it up. Can't even get close to the 21. Last time we touched it and failed was on 5-4, so 3 full weeks without even getting to that. But for now, this 3,900 area is holding as support. Really don't want to go below that. Let's check the other 4 indexes. NASDAQ 100 didn't undercut Friday. Lack of relative strength continues, going all the way back to 4.4, really going all the way back to 11.30. But after this last hurrah run up that we had that failed into the 200-day moving average before rolling over again, and really this is you could argue it's a third leg down, but really it looks more like a second leg down, which could indicate if we have a third leg down that we could be going substantially lower. I'm not going to take anything off the table because, as you know, we frequently say risk picks up significantly when you're under the 200-day moving average. Just that one rule alone would save people so much money, so much physical and mental capital by obeying that rule. But people are going to do what people are going to do. So we bottom lined it and we reviewed the levels. We got a long way to go climbing back above these. How about Dow Jones Industrial Average now? Here's the DIA. 2 up days off of the spike low of 520. Relative strength on the Dow, you can see the line here continues, very typical. This is the defensive index when we're in a bear market. Mid caps, MDY, no relative strength on these over the last couple of days, but still holding the lows of yesterday and a couple of weeks ago. We didn't break those, so really relative strength from that standpoint versus the lows from back around 510, 511, 512. And small caps, we didn't break those lows from 511, 512, and didn't undercut Monday or last Friday also. So always want to point out the good along with the bad and the ugly here at Revere. So how about from an individual stock standpoint, what do we want to take a look at? How about we go to the 21 over 21 and see the top 5 from each. Hold on one second. So let's sort these by price percent change today. Well, it would help if I got to the right list first. Price percent change on the day. So the best ones, AT&T continues to show relative strength with its beautiful negative earnings growth for 2022 and no earnings growth for 2023, but I guess that's better than losing money. Eli Lilly continues to show relative strength. In fact, RS at a new high, one of the best charts out there. Merck, also one of the best charts out there. Look at the relative strength on that. And they're not a bunch of dirtbags the way Pfizer are. Chevron looking good, along with Exxon looking good in the oil patch. How about the worst 5 on the day? ON Semiconductor, no, LNTH, something that really had been holding up fine, but when you try to go with the needle in the haystack, you might end up down 4 or 5% in a day, which is very typical of what you've seen in any strong stocks in this market. ON Semi, one of the best charts in semi land, not today, breaking below the 50 and the 21 and the 200-day moving average. Starbulk, good day yesterday and a hammer today, but down 2.4%. OLN, chemical company, bounced off the 21-day exponential moving average, and GOGL, another shipper, near all-time highs, gentle pullback hammer off the 8 EMA. So those are the best 5 and the worst 5 from the 21 over 21 list. Let's see, anything else stand out to me today? Let me check my notes for anything that I want to make a note of, and I don't. Oh yeah, ALB. This is going to find its way into the 21 over 21 if this holds up. Relative strength at a new high today. They upped guidance for the second time within a month. If the market was acting better, this stock would be acting better, but it is forming a decent cup base, 42%, a little on the deep side, but growing their earnings, PE of 46, seems high, but not necessarily if you compare it to the 2022 earnings growth of 154%. So also in the same group, LTHM, big need for lithium, people. In EVs, you can see how this has had two weeks straight up after a harsh week down, after an earnings gap up, still forming this jagged cup base that's 41% deep. But when you're looking for needles in a haystack, we're pointing them out, and 2 of them are in the chemicals group, specifically lithium within the chemicals group, and that's going to wrap it today. As always, love to hear from you. You can email me, don@revereasset.com, or phone 855 Real Wealth. Wrapping up Tuesday, May 24th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.